Now, this problem is a continuation of our analysis of Fox Manufacturing. And in the previous problem, now the previous part of this problem, we did liquidity analysis. That is, we looked at the firm's ability to meet its short-term indebtedness. Now, in this next section now, we're going to do activity ratios. Now, activity ratios measure the firm's ability to utilize its resources. Now, the resources, the financial resources of the company, are the assets on the balance sheet. So what you'll see here in each of these now is a certain asset, whether it's accounts receivables or inventory or total assets. And the way you utilize your assets is that you want to measure their ability to generate revenue or cost of goods sold. And so in one of these we'll use cost of goods sold in the numerator, and the rest of them we'll use sales. But at any rate, we're looking at activity analysis now. The ability of the firm to utilize its resources, its assets. And the first one they want us to talk about, this is inventory turnover. Now, inventory turnover is defined as cost of goods sold over inventory. So if you go to this company's income statement and balance sheet now, off the income statement you'll find that cost of goods sold is $460,000. And off the balance sheet you'll find that inventory is $82,000. So if you take cost of goods sold divided by inventory, you find that this company's average is 5.61. And that's $5.61. And what that means is that for every dollar this company invests in inventory, it's generating $5.61 in sales, or cost of goods sold. The typical firm in the industry now is only generating $4.55. So what you'll see here with inventory turnover is the higher the number, the more you like it. You want it to generate more dollars in revenue per dollar invested than less. The way you would analyze this now, what you'd say is that this firm's ability to generate revenue from its investment in inventory is superior to that of the typical firm in the industry. This is inventory turnover. The next one we're going to talk about now, this is average collection period, sometimes called days sales outstanding. And it's defined as accounts receivables over sales times the number of days in the year. And in this problem, they told us to use 365 days. So if we wanted to calculate the average collection period for Fox Manufacturing now, we would take accounts receivables off the balance sheet, which is $34,100. Divide that by sales, which is $600,000. Take that answer, multiply it by 365, the number of days in the year. And what you find for Fox Manufacturing is that their average collection period, or days sales outstanding, is 20.7. Now that's 20.7 days. So the typical customer that comes into the business and doesn't leave cash, doesn't pay for it, but rather, says charge it, creates a receivable. Fox Manufacturing now is not seeing any cash for that sale for 20.7 days. The typical firm in the industry doesn't see any cash for their credit sales for 35.8 days. Now, all things being equal, what would you like? Well, you'd like your average collection period to be smaller as opposed to larger. So the way you would analyze this is you would say, Fox Manufacturing's ability to collect revenue, to collect cash from its credit sales now is superior to that of the typical firm in the industry. Fox takes 20.7 days to collect on receivables. The typical firm in the industry is taking 35.8 days. The last activity ratio they want us to look at now, this is total asset turnover. Sales divided by total assets. And if you go to the financial statements here, sales is $600,000 and assets, total assets, is $408,300. Sales over total assets for Fox Manufacturing, 1.47. And again, that's $1.47, which means that for every dollar that Fox Manufacturing invests in total assets, it generates $1.47 in sales. The typical firm in the industry only generates $1.09. Again, This is a ratio that you want to be higher as opposed to lower. The way you would analyze this, Fox Manufacturing's ability to generate revenue from its investment in total assets is superior to that of the typical firm in the industry. This is a total asset turnover, and these were activity ratios, which again, measure the firm's ability to utilize its resources.